February 14th, 2026, Valentine's Day. And while most people are thinking about flowers and chocolates, I'm going to tell you about something that should genuinely terrify anyone who owns silver. In just 7 days, between February 4th and February 11th, 33.45 million ounces vanished from COMEX registered vaults. Let me say that number again so it sinks in. 33.45 million ounces. Gone in 7 days. But here's where this gets absolutely wild, and I need you to stay with me because this is going to sound like it doesn't make sense. Silver is currently trading around $82 per ounce. That's down from $121 just 2 weeks ago, a 30% crash. One of the worst single-day drops in silver history since 1980. The paper price is collapsing, yet physical silver is disappearing from vaults at a rate we've never seen before. The Perth Mint in Australia just announced they're limiting orders and pausing sales. The US Mint is operating at drastically reduced capacity. Shanghai is paying a 29% premium over Western prices. And when you factor in the 13% VAT tax, they're paying $36 more per ounce than you can supposedly buy it for on COMEX. If you're holding silver right now and you're scared, if you're confused about whether to buy or sell, if you're wondering what on earth is happening in this market, stop scrolling and watch this entire video. By the end, you will understand exactly what's happening, who's doing it, why they're doing it, and most importantly, what this means for your silver holdings in the next 30 to 60 days. But first, if you're not subscribed to this channel, hit that subscribe button right now, because what I'm about to show you is not being discussed anywhere in mainstream financial media, and you need to see the evidence. Let me take you back to January 30th, 2026, 26 days ago. It was a Thursday evening going into Friday morning, and silver had just hit its all-time high of $121 per ounce. I remember watching the charts. Everything looked euphoric. Silver had rallied 250% over the previous 12 months. Retail investors were piling in. Social media was exploding with predictions of silver going to $200, $300, and then, in less than 30 hours, it was over. By Friday afternoon, silver had crashed from $121 all the way down to $74, a $47 drop, 33%, wiped out. Let me show you what happened minute by minute because the timing tells you everything you need to know. The crash started after midnight Shanghai time on Saturday. That's important. The crash started after London closed. It happened during US trading hours on the CME COMEX in New York. And here's what the mainstream media told you. They said it was because President Trump nominated Kevin Warsh as the next Federal Reserve Chair. They said Warsh is a hawk who won't print money, so the dollar rallied and precious metals crashed. They said it was margin calls. They said it was over-leveraged Chinese traders getting liquidated. They said it was a bubble that had to pop. Let me tell you what they didn't say. On January 7th, 2026, 3 weeks before the crash, COMEX saw delivery of 8.1 million ounces in a single day. JP Morgan delivered 99% of that total. January is historically a tiny delivery month for silver, typically 1 to 5 million ounces for the entire month. But in January 2026, total deliveries reached 49.4 million ounces. That's 7.27 times higher than January 2024. It's 4 times higher than January 2025. This wasn't speculation. This was physical offtake. People were standing for delivery and taking actual metal out of the system. Now watch what happened in February. As of early February, 18.72 million ounces have been called for delivery out of 19.11 million ounces of open interest. That's a 98% delivery rate. Read that again. 98% of contracts are demanding physical metal. A functioning futures market doesn't work like that. Futures markets are supposed to be about price discovery and hedging. Contracts are supposed to roll forward to the next month. They're not supposed to result in mass physical delivery. But that's exactly what's happening. The COMEX has become a physical allocation mechanism, and the vaults are being drained at a rate of 785,000 ounces per day. Let that sink in for a second. 785,000 ounces per day. Every single day. Now let me show you what the inventory numbers look like. In October 2025, just 4 months ago, COMEX registered silver inventory stood at 167.7 million ounces. Registered inventory is the metal that's actually available for delivery against futures contracts. It's the real inventory. By February 11th, 2026, that number had fallen to 98.138 million ounces. That's a 38% decline in just over 3 months. On February 11th alone, 3.25 million ounces were withdrawn from the registered category in a single-day negative adjustment. More than 4.7 million ounces were pulled from eligible inventory the same day. Total withdrawals in one day, 4.7 million ounces. The registered inventory fell below the critical 100 million ounce threshold for the first time in years. Now here's where this gets absolutely critical, and I need you to understand the math because this is terrifying. March 2026 is the next major delivery month for silver futures. Open interest in the March contract currently represents 429 million ounces. Maybe it's closer to 455 million ounces, depending on which source you check. The registered inventory available for delivery is now 98 million ounces and falling every single day. If only 25% of those contracts stand for delivery, that's 107 million ounces. They don't have it. If 50% stand for delivery, which is what happened in December 2025, that's 200 to 225 million ounces. They absolutely don't have it. First notice day for March contracts is February 27th. That's 13 days from today. If the current drainage rate continues at 785,000 ounces per day, by February 27th, there may only be 85 million ounces left in registered inventory. Now I want you to think about what I just told you. The paper price crashed 33%, the worst crash since 1980. But the physical demand didn't stop. It accelerated. This is not coincidence. Let me explain what's really happening here and why the January 30th crash failed to fix anything. The crash was supposed to shake out the leveraged speculators. That part worked. Thousands of traders who bought silver at $110, $115, $120 got margin called and liquidated. The CME raised margin requirements from 11% to 15% right after the crash, a 35% increase. That forced even more selling. But here's what didn't happen. The physical buyers didn't sell. After the crash, iShares SLV Silver ETF saw 1,023 tons, approximately 32.9 million ounces, flow in during a single day in early February. That was the third largest single-day inflow in the ETF's entire history. That's not panic selling. That's opportunistic buying. And more importantly, the Eastern buyers didn't stop. Let me show you what's happening in Shanghai. On February 2nd, 2026, 3 days after the crash, the Shanghai silver cash price was trading at a 29% premium to COMEX. 29%. That's $22.98 more per ounce than the price in New York. When you factor in China's 13% VAT tax that must be paid to remove silver from exchange vaults, the true premium jumps to 45.8%, or $36.22 per ounce over Western prices. The cost of shipping and insuring bulk silver by air freight to China is about $2 per ounce, so the arbitrage opportunity for anyone who can get their hands on physical silver in London or New York and ship it to Shanghai is $34 per ounce. Think about what that means. You can buy silver on COMEX for $82, ship it to Shanghai, and sell it for $116. That's a $34 profit per ounce, or 41% return, just for moving metal from west to east. And this has been going on since late December. The Shanghai premium started expanding in December 2025 when it hit $8 per ounce. By mid-January, before the crash, Chinese silver futures had surged past $125, while COMEX was trading at $112. After the crash dropped COMEX to $80, Shanghai was still paying over $100. Right now, even 2 weeks after the massive liquidation, Shanghai prices remain dramatically elevated. Every single ounce of available silver in London and New York is being arbitraged to Asia, and there's nothing anyone can do to stop it unless they're willing to literally ban physical exports. Now let me show you what's happening at the mints, because this is where the rubber meets the road. On January 29th, 2026, 1 day before the crash, the Perth Mint sent a notice to its wholesale dealer network. Here's what it said. Due to increasing worldwide demand for silver bullion products, we have a large backlog of orders for the 2026 Kangaroo 1-ounce silver bullion coin. As a result, we have decided to pause taking wholesale orders for this coin from today until February 23rd to clear the back orders. We are also implementing a monthly allocation for this product to ensure that all regions receive stock in the current market environment. This notice went out when silver was trading at $117. The Perth Mint was already at the breaking point. Then the crash happened, and silver dropped to $74. What do you think happened to physical demand after that? It exploded. On January 22nd, the Perth Mint's chief commercial officer released a statement. They said, "There is no shortage of silver." Let me repeat their exact words. As Australia's leading precious metals refinery, we can assure you there is no shortage of silver. It just isn't in the specific forms being requested by our customers, which is putting pressure on manufacturing operations. Read between those lines. They're saying, we have silver, just not in the 1-ounce coins and 1 kilogram bars that everyone wants to buy. That's a shortage. When a major sovereign mint tells you they can't produce the products customers want in the quantities demanded, that's a shortage, no matter how they spin it. The Perth Mint has now limited order sizes on 1 kilogram cast silver bars and 1 kilogram silver coins. Some products are limited to in-store sales only. They've increased staffing in production, order fulfillment, and customer service, but they still can't keep up. Let me tell you about the U.S. Mint. In 2023, the U.S. Mint produced tens of millions of American silver eagles. In 2024, production dropped. By 2025, they were operating at significantly reduced capacity due to planchette shortages. A planchette is the blank disc of silver that gets stamped into a coin. The U.S. Mint doesn't produce its own planchettes. They outsource to companies like Sunshine Minting, Leach & Garner, and even the Perth Mint. But here's the problem. The Mint is required by law to buy silver at spot price. In the current market, getting physical delivery of silver at spot is nearly impossible. The premiums are massive. The Mint suppliers can make higher profit margins selling their own products or supplying other dealers, so the U.S. Mint gets whatever's left over. In 2026, production of silver eagles is running at a small fraction of historical norms. Representative Alex Mooney wrote a letter to Treasury Secretary Janet Yellen, alleging that the Mint is in violation of U.S. code, requiring them to produce coins in quantities sufficient to meet public demand. The U.S. Mint can't produce enough coins because they can't get enough silver planchets, because there isn't enough silver available at the prices they're legally allowed to pay. Let that sink in. The official producer of American silver coins can't source enough metal to meet demand, even though the paper price says silver is abundant. The Royal Canadian Mint reportedly had no 100-ounce bars available and dedicated nearly all silver production to the 2026 maple leaf coins. The Royal Mint in Britain was only producing silver Britannias, nothing else. The Rand refinery in South Africa ran out of silver for making Krugerrands and was waiting for product. The largest mint in India reportedly ran out of silver. This is happening globally. Every major mint on every continent simultaneously struggling to produce enough silver products. And this was happening before the crash. The crash was supposed to relieve pressure. It didn't. It made it worse. Because after the price dropped 33% in one day, every single person who had been sitting on the sidelines thinking about buying silver saw the biggest buying opportunity in years. Premiums on physical coins and bars spiked. Dealers reported record traffic. Online retailers sold out of inventory. Costco, which had been selling silver bars to retail customers, implemented purchase limits and saw inventory disappear within hours whenever it became available. In Japan, physical premiums hit 80% over spot during the decoupling. In the UAE, similar levels. Indian exchanges showed persistent premiums over COMEX pricing. Now I need you to stop for a second and think about this. Really think about it. The paper price crashed 33%. That's supposed to indicate abundant supply and falling demand. But the physical price, the price real people pay for real metal they can hold in their hands, went up. Premiums expanded. Wait times got longer. Mints suspended sales. This is not how markets are supposed to work. When the price of something crashes, it should become easier to buy, not harder. This is the great divorce. The paper market and the physical market have completely disconnected. Let me show you why this happened and who's responsible. Between January 29th and January 30th, during U.S. trading hours specifically, silver was sold relentlessly on the COMEX futures market. The price started dropping after midnight Shanghai time, after London closed, leaving New York as the dominant price-setting platform. The selling was so aggressive that the price fell $47 in less than 30 hours. No circuit breakers tripped. Trading was not halted even for a minute, despite the most violent move in over 40 years. Compare this to stock markets, where circuit breakers halt trading after 7% moves. Silver dropped 33%, and trading continued uninterrupted. Now ask yourself, who has the ability to sell hundreds of millions of dollars worth of silver futures contracts during illiquid Asian overnight hours and U.S. morning hours with such precision that it triggers a cascading liquidation? Retail investors don't trade like that. Individual speculators don't have that kind of firepower. This was institutional. This was coordinated. Here's what we know from the data. The crash occurred during U.S. trading hours. Not Asian hours, not European hours, U.S. hours. The crash occurred when London, the world's largest physical silver market, was closed and couldn't absorb selling pressure. The crash occurred right after Shanghai closed for the weekend, removing the physical bid from the market. The crash occurred on the last trading day of the month, when liquidity naturally thins and month-end position adjustments create volatility. The crash occurred within days of the CME raising margin requirements, which reduced available leverage and forced traders to either post more collateral or liquidate. The crash occurred after silver had hit $121, and open interest in March COMEX contracts represented 429 million ounces against 98 million ounces of registered inventory. If you wanted to deliberately engineer a price crash to shake out leveraged longs and delay a potential COMEX delivery default in March, this is exactly how you would do it. And the timing was perfect. President Trump's announcement about Kevin Warsh gave the media a convenient narrative. A policy hawk at the Fed, expectations of fewer rate cuts, dollar strength. It all made sense on the surface. But the real story is in the vault data. The real story is in the delivery numbers. The real story is in Shanghai paying $36 per ounce over COMEX to get physical metal. The real story is in every major mint on Earth simultaneously unable to meet demand. Let me take you back to 1979 and 1980, because this has happened before. In 1979, the Hunt brothers of Texas accumulated massive amounts of silver through futures contracts and demanded physical delivery. Silver went from $6 an ounce to $50 an ounce in under a year. The exchanges responded by changing the rules. They raised margin requirements. They implemented position limits. They restricted trading to liquidation only. On Silver Thursday, March 27, 1980, silver crashed from $50 to below $11. The Hunt brothers were wiped out. But here's what's different this time. In 1980, it was two billionaires trying to corner the market. This time, it's sovereign nations. It's central banks. It's the entire Asian continent. China has designated silver as a strategic asset. On January 1, 2026, China implemented export restrictions on silver. You can't just ship silver out of China anymore. It's controlled. China produced approximately 4,000 tons of silver in 2025 from mining and recycling. That's nearly 130 million ounces. Almost none of it is reaching the global market. India is buying, the Middle East is buying. Russia has been accumulating gold and silver as part of its de-dollarization strategy. You can't stop sovereign nations from buying physical assets. You can't margin call a central bank. You can't liquidate the Shanghai Futures Exchange. This is not the Hunt brothers. This is a structural shift in global silver flows from west to east, from paper claims to physical metal, and it's unstoppable. Now let me tell you what happened after the crash, because this is the part that should scare you. The price recovered somewhat. From the low of $74, silver bounced back to the mid-80s. As of today, February 14th, we're around $82. That's still 32% below the highs, but it's $8 above the crash lows. But the inventory drain didn't stop. On February 11th, 3.25 million ounces left registered inventory in one day. 4.7 million total ounces left the system. The 98% delivery rate in February contracts continued. Shanghai premiums remained elevated. The Perth Mint backlog got worse, not better. Why? Because the paper price crashed, but the physical fundamentals didn't change. Global silver production has been in deficit for 5 consecutive years. The 2026 supply deficit is projected to approach 200 million ounces. Industrial demand from solar panels, electric vehicles, 5G infrastructure, AI hardware, and medical applications is growing faster than mine output. Silver solid-state batteries for EVs are entering mass production, threatening to consume massive quantities of silver annually. Every Tesla, every electric vehicle, uses silver in its electrical systems. Every solar panel uses silver paste for conductivity. Every AI server farm uses silver in circuit boards. This demand is not discretionary. You can't build a solar panel without silver. There's no substitute with the same electrical conductivity at an economically viable price. This demand is structural, and it's accelerating. Meanwhile, mine supply is relatively inelastic. Silver is mostly produced as a byproduct of copper, lead, and zinc mining. Only about 30% of silver comes from primary silver mines. You can't just decide to produce more silver like you can increase oil drilling or wheat planting. It takes years to develop a new mine. The price would need to stay elevated long enough to justify massive capital expenditure. By the time those mines come online, we'll be years into this deficit. The deficit is real. The demand is real. The supply constraints are real. But the paper price crashed 33%. How does that make sense? It doesn't, unless you understand that COMEX isn't a physical silver market anymore. It's a price suppression mechanism. Let me explain how it works. There are currently about 100 million ounces of registered silver in COMEX vaults. The open interest in March contracts represents 429 million ounces. That's a ratio of about 4 to 1. For every ounce of actual silver, there are 4 claims. Now, normally, most futures contracts don't result in delivery. Traders close positions before expiration. They roll to the next month. They settle in cash. The system works as long as only a small percentage of contracts demand physical delivery. But what happens when that breaks down? What happens when 50% or 70% of contracts stand for delivery like we're seeing now? What happens when COMEX runs out of silver to deliver? Historically, when a futures exchange can't meet delivery obligations, several things can happen. They can raise margin requirements to force liquidations. They did that. They can implement position limits. They can restrict trading to liquidation only, like in 1980. They can declare force majeure, essentially defaulting on contracts and settling in cash at whatever price they decree. Or they can allow exchange for physical transactions, where instead of delivering silver in New York, they give you a contract for silver in London, plus some cash to compensate you for the inconvenience and expense of taking delivery across the ocean. The U.S. Mint has increasingly relied on this last option because getting physical silver delivered in New York has become problematic. Think about what that means. The world's largest silver futures exchange can't reliably deliver physical silver in New York, so they're sending buyers to London. And now London is having problems too. Reports from 2025 indicated the London silver market, the world's largest physical bullion market, was experiencing delivery dysfunction. Days of trading where promised metal didn't materialize. The thesis that's been building in precious metals research communities is that London has been operating on a fractional reserve basis for years, with claims on silver vastly exceeding actual metal in vaults. When this became known, savvy institutions started selling their unallocated London claims, taking the cash, and buying allocated storage elsewhere, or demanding immediate physical delivery in other markets. That's what's draining COMEX. That's what's sending premiums in Shanghai to 40%. The system is being stress tested, and it's failing. Now let me tell you about the 3 types of people watching this video right now. The first group is scared. You bought silver at $90 or $100, watched it crash, and now you're wondering if you should sell and cut your losses. You're thinking maybe silver is going back to $30. Maybe this whole thing was a bubble. Maybe you should get out before it gets worse. Let me tell you something. If you sell now, you're giving your silver to exactly the people who engineered this crash. That's the whole point. They need physical metal. They can't get it at $120 because no one will sell at that price. But crash it to $74, panic retail holders into selling, and suddenly metal becomes available. Then they ship it to Shanghai and collect a $36 per ounce premium. You're literally funding their arbitrage. The second group is confused. You don't know what to believe. The price chart says one thing. The vault data says another. The mainstream media says it's over. Alternative media says it's just beginning. YouTube is full of people screaming about silver going to $500 and an equal number saying it's going to $20. You're paralyzed. You don't know whether to buy, sell, or hold. Let me give you a framework. Ignore the price. I know that sounds crazy, but hear me out. The price is being set on a futures exchange that may not be able to deliver the underlying asset. The price is being determined by paper contracts that outnumber physical metal 4 to 1 or more. That price is increasingly irrelevant. What matters is, can you get physical metal? At what premium? With what delivery time frame? If the price is $82, but you have to pay $15 premium and wait 12 weeks, the real price is $97. If Shanghai is paying $116, that's the real price. The paper price is a fiction maintained by an exchange that's running out of inventory. The third group understands. You've been watching this develop for months or years. You've been stacking physical silver because you knew this day was coming. You understand that every fiat currency in history has eventually failed. You understand that silver and gold are money. Everything else is credit. You understand that when the paper market breaks, physical will be repriced dramatically higher. You're not scared of volatility. You're excited by it because you know this crash created a historic buying opportunity. If you're in this third group, you already know what to do. You're buying every dip. You're taking delivery. You're holding outside the banking system. You're patient. Let me tell you what I think happens next. March 27th is first notice day for March COMEX contracts. Between now and then, we're going to see whether COMEX can meet delivery demands. If they can't, if we see delivery delays, cash settlements, or force majeure declarations, confidence in paper silver will evaporate overnight. If they can meet deliveries, it will be because they drained every last ounce from registered inventory, which sets up an even worse situation in May, the next major delivery month. Either way, the trend is clear. Registered inventory is declining, delivery demands are increasing, premiums in physical markets are rising, mints can't keep up with production. This doesn't end with silver going back to $30. This ends with a complete repricing of silver in physical terms, disconnected from paper contracts. The conservative case, the case where nothing dramatic happens and this just plays out slowly over months, is that silver retests and breaks through $100 per ounce by summer 2026. The base case, the most likely scenario, is that we see continued volatility with sharp drops during U.S. trading hours, followed by recovery as physical demand absorbs the selling, with silver reaching $120 to $150 by late 2026. The bull case, if COMEX has delivery problems, or if China accelerates purchases, or if another major bank gets caught short, is that silver spikes to $200 or higher as the paper market completely loses credibility and pricing shifts entirely to physical markets like Shanghai. The bear case, the case where I'm completely wrong, is that COMEX somehow finds a massive influx of new supply, Shanghai premiums collapse, mints catch up with production, and silver falls back towards $60 to $70. I'm assigning about a 5% probability to that scenario because I don't see where the supply comes from. You can't print silver, you can't create it out of thin air, you either have it or you don't. And increasingly, the Western vaults don't have it. So what should you do? If you own physical silver, hold it. Don't let price volatility shake you out. Understand that this volatility is the system breaking, not silver failing. If you're thinking about buying silver, I would suggest focusing on getting the lowest premium physical product you can source with reasonable delivery times. 1 ounce government coins like American Eagles, Canadian Maples, British Britannias if you can get them, 10 ounce bars from reputable refiners, 100 ounce bars if available, though those are harder to find. Avoid numismatics and collectibles right now unless that's specifically what you collect. This is about metal weight, not pretty packaging. If you're trading silver futures or silver mining stocks, understand that you're playing in a completely different market than physical. The paper price can be manipulated. Mining stocks can crash even if long-term fundamentals are positive. If that's your game, you need tight risk management and the ability to ride out insane volatility. If you're in unallocated storage programs, meaning you own silver but the institution holds it and you don't have specifically allocated bars with serial numbers in your name, consider moving to allocated or taking physical delivery. Unallocated silver is a claim on silver, not actual silver. And if the institution has rehypothecated that metal or doesn't actually have it, you could have problems. And most importantly, if you don't own any silver and you're just watching this out of curiosity, understand that what's happening in the silver market right now is a preview of what will eventually happen to every asset that's been financialized into paper derivatives. It happened in oil in 2020 when futures went negative. It's happening in silver now. It will happen in other commodities. The paper markets have become so detached from physical reality that they're breaking. Let me leave you with this. 33.45 million ounces vanished from COMEX in 7 days. The price crashed 30%, but physical premiums went up. Mints are rationing sales. Shanghai is paying $36 over spot. Delivery rates are 98%. March contracts represent 4 times available inventory. This is not normal. This is not a functioning market. This is a market in the process of breaking. And when it breaks completely, when COMEX can no longer provide the illusion of infinite paper silver backed by finite physical silver, the repricing will be spectacular. If you found this video valuable, if you now understand what's really happening in silver markets, I need you to do 3 things. First, subscribe to this channel and hit the notification bell, because this story is developing rapidly and you need to stay informed. Second, smash that like button so this video reaches more people. The mainstream media is not covering this accurately, and people need to see the real data. Third, leave a comment below telling me, do you own physical silver? Are you buying this dip? And what do you think happens in March when those delivery notices come due? I read every comment, and I want to hear your perspective. This is the biggest story in commodity markets right now, and almost nobody is talking about it. Thank you for watching, thank you for being part of this community, and I'll see you in the next video, where we'll track exactly what happens as we approach that March 27th deadline. Stay sharp, stay informed, and remember, when the paper market crashes, but the metal keeps disappearing from vaults, something is very, very wrong.